Does anything in particular, Howard, strike you as most vulnerable or most dangerous right now?
Absolutely not, Eric. I think it's evenly spread about. The main cause for all of this is uniform and applies to everything, and that is the low level of interest rates. Low interest rates cause for inflated valuations of everything, and by being so unappealing to investors on safe instruments, they push everybody out the yield curve to do risky things. The real question is, how do you make a good return in a low-return world?
Okay, so how do you do that?
Well,
what out there offers the appropriate mix of risk and reward right now?
there is no magic. There is no magic solution.
Well, there has to be something.
Well, no.
I mean, let me float a few ideas.
Yes.
Right? Credit spreads are awfully tight.
Yes.
You might say that things are getting expensive in the high-yield market.
Yes.
Is an investor better off today, safer, buying an investment-grade bond than a high-yield bond? Or is he better off buying treasuries or agencies?
Well, I mean, that's the dilemma, and that's why there's no easy answer today. You're safer buying a treasury that yields 1 or 2, but high yield yields 5 or 6, and you may have to wait a few years before the treasury turns out to have been the right thing to do, in which case you passed by 8, 12 points of yield.
I know it's not easy,
right,
but the reason people are watching us having this conversation is because they too are struggling, trying to figure out what to do. So let's give them a few ideas.
Okay, the only thing I'm confident about, Eric, is that within every strategy and market niche, whether it's high yield or emerging market debt or equities, there are riskier and less risky things to do. And at this point, I would be moving toward the less risky.